The party was supposed to be epic. The champagne was on ice, the Ethereum ETFs launched, and the rocket was fueled for a trip to the moon. But the launch was a dud. The countdown hit zero, and instead of a spectacular liftoff, there was a fizzle. A wave of profound disappointment is now washing over the market, leaving investors questioning everything. Was the hype just a lie? Was this the ultimate sell the news event? While most of the market is staring at the disappointing price chart, they are completely missing the silent, multi-trillion-dollar infrastructure being built right under their feet. The real story isn't the price, it's the plumbing. In the next few minutes, we are going to ignore the loud disappointment of the market's surface and explore the silent seismic shifts happening in the depths, shifts that will ultimately determine the real winners and losers of this cycle. Let's first dissect the aftermath of the Ethereum ETF launch. For months, this event was heralded as the catalyst that would unlock a torrent of institutional capital and ignite a new season for altcoins. The day finally came, the ETFs began trading, but the market's reaction was meh. The price of ETH remained flat, even dipping slightly, leaving hopeful investors in a state of shock. So what happened? Two powerful forces were at play. First, the market had already priced in the event. The price of Ethereum had rallied significantly in the weeks leading up to the launch as smart money anticipated the approval. By the time the news was official, there were no new buyers left at the current prices. Second, and more importantly, the grayscale ETH bomb detonated exactly as predicted. The Grayscale Ethereum Trust, ETHE, which held billions in locked-up ETH, began experiencing a massive, sustained wave of outflows. Just as with the Bitcoin ETFs, investors fled the high-fee Grayscale product for the new, cheaper alternatives, creating a wall of selling pressure that absorbed all the fresh inflows. This classic buy the rumor, sell the news scenario has left a bitter taste in the market's mouth and created a significant headwind for Ethereum in the short term. This price weakness is now being reflected in the behavior of the market's largest players. A crucial on-chain metric we must watch is the exchange whale ratio. This ratio simply measures the size of the top 10 transactions flowing into exchanges compared to all other inflows. When this ratio spikes, it means that whales, large, wealthy holders, are moving significant amounts of their crypto onto exchanges, often as a prelude to selling. In the last 48 hours, this metric has seen a significant and sustained spike for both Bitcoin and Ethereum. This is a clear warning sign. It suggests that some of the largest players, who may have bought the recent dips, are now using this period of market uncertainty to distribute their holdings and de-risk their portfolios. While this is not a guaranteed predictor of a market crash, it is a data-driven signal that the smart money is becoming cautious. The risk of a major correction has increased, and we must pay close attention to this whale activity in the coming days. Adding to this caution is a new development from the global regulatory stage. This week, the finance ministers of the G7 nations released a joint statement following their recent summit. For the first time, they collectively called for the creation of a unified global framework for crypto regulation, with a specific focus on anti-money laundering standards and the oversight of global stablecoin issuers. This signals the end of the Wild West era of regulatory arbitrage, where crypto projects could simply move to more friendly jurisdictions to avoid strict rules. A coordinated global regulatory net is now being woven. This is a double-edged sword. On the one hand, it adds a layer of legitimacy and security to the space, which is a necessary precondition for attracting the world's largest and most conservative pools of capital, like pension funds and sovereign wealth funds. On the other hand, it represents a direct threat to the permissionless and privacy-centric ethos upon which crypto was founded. This coordinated pressure will accelerate the controlled burn we've discussed before, separating the projects that are willing to comply from those that are not. But now, we must look away from the fire and distraction of the price charts and regulatory headlines, because the most important news of the week
happened almost silently. Google Cloud announced the official launch of its institutional-grade Ethereum staking service. Let's be absolutely clear why this is a bigger deal than any company simply buying Bitcoin. This is not a financial speculation. It is a deep, foundational infrastructure play. Google is not betting on the price of ETH next month. They are betting on the Ethereum network being a fundamental layer of the next generation of the internet. They are positioning themselves to be the premier picks and shovels provider for this new digital economy. This service makes it simple and secure for massive institutions who cannot handle the technical complexity of running their own validators to stake their ETH and earn yield. This single move unlocks a vast new pool of long-term, yield-seeking capital that was previously sitting on the sidelines. This is the silent tectonic shift happening beneath the surface. While traders are disappointed by the ETF launch, one of the world's largest technology companies is integrating itself directly into the core plumbing of the network. This long-term building is not just happening at the corporate level. The very purpose of this technology is expanding into new frontiers. A new narrative is quietly gaining momentum, one that put a potential to be even more impactful than DeFi or NFTs. DeSci, or decentralized science. For decades, scientific research has been plagued by systemic problems. Funding is controlled by a handful of centralized institutions, valuable data is locked away in private silos, and research papers are hidden behind the paywalls of academic journals. DeSci aims to solve these problems using blockchain. New platforms are creating DAOs, or decentralized autonomous organizations, to transparently fund novel research based on community voting. They're using the blockchain to create a permanent, verifiable, and public record of scientific data, preventing it from being manipulated or suppressed. And they're using NFTs to represent intellectual property, allowing for new models of ownership and collaboration. This is a powerful, real-world use case that demonstrates crypto's potential to disrupt more than just finance. So we are left with a profound disconnect. The surface of the market is a sea of red filled with disappointment from the ETF launch, fear of whale selling, and the tightening grip of global regulation. By all surface-level metrics, the outlook appears bearish. But if you look deeper beneath the waves, the true foundation of this new economy is being fortified in ways that are far more significant than short-term price action. Global technology giants are building in the essential infrastructure, and new, world-changing use cases like DeSci are proving the long-term value of the technology. The market is currently designed to test your conviction. It is shaking out those who only watch the price and rewarding those who watch the progress. The only question is, where are you looking? If this deep dive provided you with a new level of clarity, please help us grow this channel. Like this video, comment below with your thoughts on the future of DeSci, and share this video with a friend who is feeling discouraged by the current market. Be sure to subscribe and hit the notification bell for more analysis that goes beyond the noise. Thank you for watching.